At the close of business on December 16, 2025, the COMEX division of the CME Group implemented a 10% increase in margin requirements for silver futures contracts, elevating the initial margin to $22,000 per contract from the previous $20,000 level, a move that underscores the exchange's efforts to mitigate escalating volatility as silver prices approached an all-time high of $64.66 per troy ounce just 4 days earlier. This adjustment, far from a routine market calibration, functions as a deliberate liquidity drain mechanism designed to compel the unwinding of leveraged positions and restore order during periods of rapid price appreciation, carrying significant consequences for long-term holders who must now reassess their exposure amid heightened capital demands and potential short-term price suppression. For those of us focused on wealth protection through precious metals, this intervention highlights a critical tension in the silver market. While it aims to de-risk the paper futures arena, it inadvertently amplifies signals of an underlying structural deficit in physical supply, prompting us to evaluate how such regulatory tools could either stabilize portfolios or create strategic entry points for accumulation. To fully appreciate the implications of this margin hike, we must first contextualize it within the broader volatility event that precipitated it, tracing silver's trajectory through 2025 and the sequence of events leading to this decisive action. Silver began the year trading around $28.92 per ounce in January, but a confluence of factors, including surging industrial demand from solar photovoltaic production and electric vehicle manufacturing, propelled prices upward by nearly 123% to the December 12 peak of $64.66, surpassing the previous nominal high of $49.45 set in April 2011. This ascent was not uniform. Mid-year corrections tied to Federal Reserve rate adjustments briefly pulled prices back to the $40 range, only for renewed buying pressure from institutional investors and sovereign funds to drive the late-year breakout. The liquidity drain concept here refers to the exchange's strategy of increasing collateral requirements to force speculators, particularly those with high leverage, to either post additional capital or liquidate positions, thereby reducing overall market liquidity and curbing upward momentum without imposing outright trading halts. Historical precedents abound, such as the multiple margin increases in 2011 when silver approached $50, which ultimately contributed to a 30% price retracement over subsequent months. For long-term holders, this means recognizing that while such measures can induce temporary downside pressure, potentially dropping prices 5 to 10% in the near term, they often precede periods of consolidation that favor patient accumulation, especially as underlying fundamentals remain intact. Why does this specific hike matter now? It directly responds to the volatility spike at the $64.66 level, where daily trading volumes exceeded 150,000 contracts, straining exchange infrastructure and raising concerns over orderly market function, setting the stage for a deeper examination of the regulatory protocols employed. Central to this intervention is Protocol 589, formerly known as CME Rule 589 governing special price fluctuation limits, which incorporates dynamic circuit breakers to manage extreme price movements in futures contracts, including silver. Under Rule 589, dynamic circuit breakers operate on a rolling 60-minute basis, triggering a temporary trading pause if prices move beyond predefined thresholds, typically 3.5% to 5% for metals, allowing market participants to reassess and preventing cascading liquidations that could exacerbate volatility. This mechanism was notably activated during silver's December surge, with intraday halts occurring on December 10th and 11th as prices breached the upper limits, drawing from amendments to the rule in 2020 that expanded its application to include dynamic resets based on recent price action rather than static daily bands. To dismantle its mechanics further, consider how the breaker calculates limits. It references the settlement price from the prior session and applies a percentage band that adjusts in real time, ensuring that if a contract like COMEX silver futures moves upward by more than 5% in under an hour, trading halts for 5 minutes to facilitate order book replenishment. Historical applications, such as during the 2020 energy market turmoil, demonstrate its effectiveness in stabilizing contracts, but they also reveal limitations. Pauses can sometimes lead to pent-up order flow that intensifies moves upon resumption. For us as strategic investors, this raises a key curiosity. Why do these breakers often precede margin adjustments like the one on December 16th? The answer lies in their complementary roles. Breakers provide immediate intervention, while margins address sustained leverage risks. as evidenced by the CME's emergency action in March 2020 for palladium futures, where limits were doubled to 10% amid similar volatility. This interplay not only protects market integrity, but also signals to long-term holders that such tools are reactive to genuine supply-demand imbalances, which we'll explore further when discussing how they intersect with measures targeting high-frequency trading activities. Building on these circuit breakers, the concept of a steel ceiling emerges as a metaphorical yet practical framework for the layered restrictions imposed to constrain high-frequency traders who thrive on rapid order execution during volatile periods but face heightened scrutiny under CME regulations. While not an official term, the steel ceiling encapsulates the combination of widened bid-ask spreads, velocity limits, and position accountability rules embedded within Rule 589 and broader CME guidelines, effectively capping the speed and scale of HFT operations to prevent market distortion. High-frequency traders, defined by the CFTC as entities using algorithms for sub-second order placement, have been subject to increased regulatory oversight since the 2010 flash crash, with CME amendments in 2016 and 2022 introducing pre-trade risk controls and mandatory testing for algorithms to deter manipulative practices like spoofing. In the context of silver's 2025 rally, this ceiling manifests through dynamic limits that reset every 60 minutes, punishing HFT by elevating capital costs. For instance, the margin hike to $22,000 forces these traders to allocate more collateral per contract, potentially reducing their participation from 40% of daily volume, as observed in prior metal spikes. Why does this specifically target HFT? Their strategies rely on low-latency arbitrage and momentum trading, which become unviable under halted sessions or widened spreads, as seen in the 2014 Congressional Review of HFT in derivatives markets, where such measures were recommended to enhance resiliency. For long-term holders, this exposure matters because while it may temporarily suppress prices by sidelining speculative buyers, it ultimately underscores the market's vulnerability to short-term actors, highlighting opportunities to diversify into physical assets during induced dips. But how does this ceiling inadvertently spotlight deeper structural issues? It does so by revealing the fragility of paper markets when physical fundamentals diverge. A paradox we'll resolve in the following analysis of the intervention's broader effects. The true paradox of this December 16th intervention lies in how it, while intended to de-risk the futures market, paradoxically confirms and accentuates silver's ongoing structural deficit. A supply shortfall projected to persist into its fifth consecutive year in 2025, with estimates ranging from 95 to 117 million ounces according to the Silver Institute's latest survey. This deficit stems from mine production stagnation. Global output is forecasted to rise only marginally to 830 million ounces amid depleting reserves in key regions like Peru and Mexico, coupled with explosive industrial demand, which accounts for over 50% of consumption and is expected to reach 680 million ounces, driven by solar panel fabrication, requiring 20% more silver per unit due to efficiency advancements. In contrast, the paper market's de-risking through margin hikes reduces speculative long positions, as evidenced by a 15% drop in open interest following similar actions in 2021, yet this does little to address the physical market's clamor for inventory, where LBMA vaults reported drawdowns exceeding 200 million ounces year-to-date and premiums on physical bars climbed to 5 to 8% above spot prices in Asian markets. Where LBMA vaults reported drawdowns exceeding 200 million ounces year-to-date and premiums on physical bars climbed to 5 to 8% above spot prices in Asian markets. Real-world references, such as JP Morgan's management of over 1 billion ounces in physical holdings, illustrate this tension, with the bank's reports noting increased delivery demands straining COMEX-eligible stocks to historic lows of under 100 million ounces. Does this intervention delay or accelerate physical premiums? Historically, as in the 1980 Hunt Brothers episode where margins were hiked amid a squeeze, it temporarily delays price discovery but accelerates premiums as refiners and industrials bid higher for available metal, fostering a debate among analysts on whether 2026 could see even wider deficits if recycling rates fail to compensate. For our purposes, this paradox validates long-term theses on silver as an inflation hedge and industrial staple, encouraging us to view such events as confirmation rather than contraindication. How do you weigh this paradox in your own allocation strategy? Sharing in the comments could help us all refine our approaches to these market dynamics. Delving deeper into the market implications, the bifurcation between paper and physical silver dynamics becomes evident, with interventions like the margin increase suppressing futures volatility, while physical markets exhibit persistent tightness that could reshape investment strategies for years ahead. In the paper realm, futures contracts saw a 12% volume decline post-hike, aligning with CFTC data showing reduced net long positions among managed money funds from 80,000 to 65,000 contracts in the week ending December 15th, as higher margins erode leverage appeal. Meanwhile, physical indicators scream scarcity. ETF inflows into vehicles like the iShares Silver Trust surged by 20 million ounces in November alone, and spot market deals in Shanghai reported premiums hitting $2 per ounce, a level last seen during the 2021 Reddit-driven squeeze. Historical analogs, such as the 2011 margin escalations that preceded a multi-year bear market but ultimately set the stage for the 2020 to 2025 bull run, remind us that paper suppression often masks physical realities. Where industrial users like Tesla and First Solar have locked in forward contracts at premiums to secure supply amid projections of a 316 million ounce cumulative deficit over 2022 to 2025. Why does this matter for long-term wealth protection? It creates asymmetric opportunities. Dips in futures prices allow entry into undervalued positions, while physical holdings benefit from rising premiums, potentially yielding 15 to 20% annualized returns if deficits widen, as Sprott Asset Management forecasts for mid-2025. Understanding these dynamics is crucial because they inform the scenarios we'll outline next, where balancing paper exposure with physical allocation optimizes resilience against regulatory whims. To translate this forensic analysis into practical guidance, let's outline realistic scenarios for silver's path post-intervention, each with tailored risk management implications for long-term holders committed to logical portfolio construction. In a bearish scenario, where further margin hikes or CFTC position limits extend suppression, perhaps amid broader commodity weakness tied to a stronger dollar, silver could retrace to the $50 to $55 range by mid-2026, mirroring the 2011 post-peak drawdown of 60%. This would stress-test allocations, necessitating diversification into correlated assets like gold or bonds at a 60-40 ratio, while using dollar cost averaging below $55 to mitigate downside without overcommitment. The base case assumes stabilization around $60 to $70 as structural deficits persist unabated, with moderate ETF inflows offsetting paper outflows and Fed easing supporting risk assets. Here, gradual accumulation during volatility windows, targeting 2 to 5% portfolio weight, capitalizes on historical cycle averages where prices recover 50% within 12 months post-intervention. Triggers include steady industrial demand growth at 4% annually, per World Silver Survey estimates, allowing for quarterly rebalancing to maintain exposure. Finally, the bullish outlook envisions a breakout above $80 if physical demand overrides regulatory caps, potentially via sovereign purchases from entities like India's central bank amid global reserve diversification, echoing the 2020 stimulus-driven rally. In this path, employ trailing stops at 10% below entry to lock in gains, while limiting silver to 10% of assets to avoid overexposure. Across all scenarios, the key is employing logic over emotion. Monitor CFTC commitment of traders reports weekly, diversify across paper and physical forms, and view interventions as signals for asymmetry. Resolving our earlier open loops, accumulation timing below key supports like $58 maximizes upside and confirmed deficits, reinforcing why preparedness trumps reaction. As we conclude this analysis, it's clear that interventions like the December 16th margin hike, while challenging in the short term, validate the enduring case for silver in diversified portfolios, positioning us to navigate uncertainty with research-backed confidence. This forensic breakdown equips us to see beyond surface volatility, fostering a partnership in long-term wealth strategies that we'll continue exploring in future videos on topics like gold's parallel dynamics or commodity supercycles. If this perspective on risks aligns with yours, consider liking the video to support more such content. Let us know in the comments your outlook on silver's deficit. Does it shift your 2026 predictions? Subscribe if you seek steady, evidence-based guidance over fleeting market noise.